There can be no real bottom, just an emotional bounce, without some resolution to the European issues in general and to Greece in particular, said Jim Cramer on yesterday's Mad Money, in a very good introductory segment on the ups and downs of the current market and what people start to talk about when the market rallies, and this European situation that's keeping a lid on any rallies. Because fears about Europe are truly dominating markets again this week. The basic problem is simple. Greece and the other pigs, Portugal, Italy, Ireland, and Spain, have too much debt. They're dependent on new bonds to pay off maturing bonds and to continue operating. As investors key in on this, they sell the bonds and demand higher interest rates, which intensifies the problem by increasing interest costs. The concern is that banks throughout Europe own these sovereign bonds as well as other debt tied to these troubled countries. The big three French banks, BNP Paribas, Societe Generale, and Crédit Agricole, are currently in the spotlight due to concerns about their exposure to Greece. Last November, Ireland was in the spotlight, and it was banks with exposure to Ireland that were getting hammered. Now, Greece is a small economy, and a default there would likely be contained. The real concern seems to be the larger economies of Spain and Italy. Last month, the European Central Bank was intervening in sovereign bond markets, and this time it was buying Spanish and Italian bonds. You can see from the chart attached to my client note that they bought about 60 billion euros, or about $80 billion worth. So it's a decent chunk for a small time period. The move was opposed by Germany's top ECB representative Jürgen Stark, whose resignation last Friday rattled financial markets. Germany is the economic backbone of the EU, and it probably can't survive without its support. The European Financial Stability Facility, the EFSF, is the other option for bailing out troubled countries. The situation is in many ways analogous to the subprime crisis that crippled the American banks in 2007 and 2008. The banks were sitting on all these subprime mortgages and subprime mortgage-backed securities. As the housing market tanked, the collateral behind these mortgages, the mortgages themselves fell in value. The banks had to take write-downs, which impaired their capital, and this raised investor concerns about if the banks were solvent, and which further intensified the pressure on their businesses because hedge funds pulled their prime brokerage accounts, counterparties worried about doing derivative trades with those banks for fear that they could make good on it, depositors were concerned about their deposits, and so it became a crisis of confidence which spiraled out of control. And that's the concern about what might happen in Europe right now, because of all the interlinkages between various banks and the debt that they've made to other countries, the derivatives deals that they're on the line for that they might not be able to fulfill, etc., etc. The last few years have been the most volatile for all of recorded history. Andrew Lo, finance professor at MIT, told the New York Times for a front page story they did this Monday on the increasing volatility in stock markets the last few years. They show some charts about the frequency of 2% intraday and closing, and 2% and 4% intraday and closing price swings for the 1960s, 1970s, 1980s, 1990s, 2000s, and then the 2010s through August of this year. And so since the start of the century, intraday price swings of greater than 4% have happened 6 times more frequently than they did in the previous 4 decades. This has certainly been the case the last few weeks with intraday stock market reversals on a regular basis. Yesterday was an example where market was down quite a bit throughout the day. A rumor surfaced that China was meeting with Italian officials to potentially buy some Italian bonds, and the S&P surged 20 points in the last 2 hours to finish in the black. As far as I'm concerned, any trading between 1100 and 1230 on the S&P is just noise. 1100 is the intermediate low established in the wake of the S&P downgrade, and 1230 is the high from the reaction rally on August 31st. We've been lurching up and down on average volume within that range for the last month. And in my opinion, things don't get interesting until one of those levels is tested.